Hi and welcome to our market update video for February 2024. So in today's video, I'm going to give you a quick update on the market performance year to date, some of the drivers of that performance, and most importantly, I'm also going to dive into three of our preferred investments from a risk return perspective for 2024. So firstly, 6 or 7 weeks into the new calendar year, the performance of equity markets has been really strong across the international equity landscape, and that has been predominantly driven by very strong US technology sector, which has reported their latest round of earnings, which are showing extremely resilient earnings growth, largely as a result of cloud computing investments and artificial intelligence investments by corporates across all sectors. So that's the first point. The second point I'd make is that Australian equities, in a relative sense, have definitely been an underperformer year to date. The Aussie equity market is a market that exhibits much lower earnings growth, but slightly more reasonable valuation multiples. But the key thing that we like about Australian equities is their income generation, in particular the franking credit that you do get as an Australian investor. And finally, global fixed income has been a bit soft year to date. However, on a looking forward basis, it's one of those asset classes that we actually think presents a pretty good setup, given that you've got higher interest rates as a starting point. And if we do get any economic shocks or slowdowns, then bonds and fixed income should present a pretty reasonable chance of delivering a capital return as well as that high level of interest income. So in terms of our high conviction views, as I was just saying, in terms of fixed income, it does provide that higher level of income than it has in many, many years. And if we do get those shocks from time to time, then fixed income does provide a nice diversification and a nice ballast in portfolios to be resilient when potentially the equity markets are in a drawdown. The second view that we have is within international equities, and we always talk about quality companies. It's one of our philosophies. That is a long-term feature of our portfolios, but particularly at this moment in time, it's one of those areas that we really like because you have slowing economic growth in the background as a result of high inflation, high interest rates, and the economic cycle reaching the end of its cycle, or potentially near the end of the cycle. And at that point in the cycle, quality companies that have pricing power, that have structural trends at their backs, should deliver more resilient earning streams, and therefore share prices should benefit from that stronger earnings trend. And finally, the third high conviction view we have is that small caps is a good way, a cheap way to invest in the equity market, as it has been an underperforming asset class over the last few years. And as interest rates peak, we think that it stands a good chance of playing catch up to their large cap peers. So very briefly, just highlighting the yields that are available within the fixed income universe. It really does range from cash at 4.35% here in Australia, all the way through government bonds, term deposits, investment grade bonds, mortgage-backed securities, and the like, where you can get yields of between 6 and up to towards 9%, which we think is a very favourable risk return proposition in portfolios, particularly given that for most investors, that sort of return is well within the sort of scope of what most investors are trying to achieve. Now, just turning our attention to the latest reporting season that we've seen over in the US. So the first point I'd make is that the earnings growth for the S&P 500 index, which is the 500 largest companies in the US, is sitting at about 4.5% year on year. Not too bad. Certainly not very strong, but certainly better than that sort of rates of earnings growth we're seeing here in Australia. The point I'd make first point is that technology has been a key driver of that earnings growth. So the tech sector in the US has driven earnings growth of about 22%. The big technology companies in the US are actually delivering earnings growth of nearly 50% year on year. And a big reason for that are those big mega cap tech stocks like Amazon, Alphabet, and Microsoft that are benefiting from cloud computing investments, as well as AI investments, which we think will have relatively long runways left in front of them. It's still early days in terms of those investments playing out. But right now we're definitely seeing a nice, strong earnings growth contribution from those trends. And then if we strip out the technology sector from the S&P 500, you're actually seeing a earnings detraction of 2.7%. So if it wasn't for the tech stocks, the earnings growth in the market would definitely be something to be concerned about. And I just wanted to give a little bit more flavor on some of those companies that are exposed to those artificial intelligence trends and those technology trends more broadly. And there are lots of different ways to invest in these themes. There's the cloud providers, the names that I've already mentioned, Amazon, Microsoft, and Google. Then you can step down into the hardware layer, companies that either make equipment to produce semiconductors or the actual graphics cards and the chips themselves, companies like NVIDIA. You can then further go sort of up the stack towards software platforms, companies that are either helping companies make sense of data or leveraging AI within their own applications like Salesforce, and they're seeing very strong earnings growth. And finally, cybersecurity is of course a very important and growing segment of the market where companies across all sectors need to make sure they've got very strong security protocols across their businesses, given that hacking is increasingly on the rise. So companies like CrowdStrike and Palo Alto definitely at the forefront and beneficiaries of some of those trends. And then just peeling back the onion on AI a little bit further, we think about cloud and AI as really being the enablers for companies to enhance and improve their productivity, which we think is going to be increasingly important going forward over the next decade or so, because you have very large proportions of populations that are actually retiring. So the labor force, the labor pool is actually shrinking. So companies are going to increasingly look to and lean on technology to become more productive and more efficient against that background of tight labor markets and companies finding it difficult to really find skilled workers. Some of the quotes that we've seen from these big tech companies in the last reporting season is from the likes of Microsoft saying we've moved from talking about AI to applying AI at scale. So it's happening. It's not just something that's going to happen in 5 or 10 years' time. It's actually happening here and now, which is a little bit different from back in 2000 when we had the internet revolution take hold, and it really took between 5 and 10 years after that point in time for the benefits of that to really start to be seen in the economy. Alphabet or Google is investing heavily in AI, and they're using AI within all their divisions, within search, within YouTube, etc. Amazon continuing to invest in invention and customer experience. So invention being the key word there, and leveraging technology to produce better experiences for their client base. And then a comment from an industrial or a European industrial, Siemens, have talked about expanding their partnerships with Microsoft and Amazon to make AI more accessible, to make sure their customers have the use of and can leverage the technology from those big tech stocks to help them with their own digital transformations going forward. So these technology trends and themes really do transcend pure tech, the tech space, and certainly into industrials and every other sector of the market. Now, I just wanted to share this video with you, which was only released a few days ago, but I think highlights just how far these generative AI tools have come. So this is a text to video tool where you can basically type in a piece of text, in this case, show me a picture or a video of a dancing kangaroo, and the AI application will actually produce that video. This one here, again, just amazing quality from a simple sentence typed into a prompt. So this technology obviously has massive ramifications for a range of industries, particularly those that are in the visual arts or creative sort of sectors, film, TV, advertising, just a few examples where this technology is going to have profound implications. It's going to obviously be able to displace a lot of graphic artists, but also on the other hand will enhance what these artists are able to produce and achieve. And partly as a result of this new technology being announced, we saw, for example, Adobe's stock price fall 7% on Friday night. So the market is really just trying to grapple and get its head around how this new technology is going to be used. So it's certainly a space we're keeping a close eye on and thinking about how these new tools may disrupt our investments, but also which companies can actually benefit from these technologies. And we think it's the, applying and shovels approach to this sector, meaning investing in companies that enable these new tools is a good way of doing that. Final piece of commentary on the tech sector. There's a lot of chat about the valuation multiple of these big tech stocks being very expensive, and in some cases that's true. But we think that there are quite a lot of differences between the big tech stocks when it comes to valuation and quality and growth for that matter. But you can see that Tesla's does look very expensive in relative terms, trading on a PE of 62 relative to an Alphabet of just over 20 times. But then you also do have other expensive names in there, like Apple, for example, which on face value may not look that expensive on a PE multiple of 27 times. However, when you include the fact that its earnings growth is only in the high single digits, that valuation does look pretty expensive and pretty stretched. So within the big tech stocks, our preferred exposures are Alphabet, Microsoft, and Amazon, the big cloud providers, because of the runway of growth that we think lie in front of them. And we tend to avoid companies that face consumer, because their earnings growth tends to be a little bit more up and down, less predictable. So Tesla and Apple would fall into that category. And then there are other names there like Meta, which has had an extremely strong share price run, makes us a little bit cautious. And in the case of Nvidia, great company, love their product, but it's certainly the most cyclical of all of these names and regularly has boom bust periods of price performance. So that's just one of those names that we tend to put in the too hard basket generally. Another company that we have talked about in the past, but would like to just provide a little bit more of an update on to listeners, is Novo Nordisk, which is the leader or one of the leaders in treating diabetes and increasingly obesity. So I think a lot of people would have heard of their products in the obesity category, being Ozempic. And that's certainly grabbing a lot of media attention, and for good reason. The chart on the screen here just shows the sheer magnitude of the impact that their drug is actually having on people that are dealing with weight issues. So you can see the chart there shows that there's a weight loss after about 12 months of 18% or so, which is clearly extremely meaningful. So that's the main reason why this company is having so much success in that category. The thing that we want to draw attention to is two things. One, the penetration of these drugs is still extremely small. It's about 2% of the total population living with obesity actually use or take these drugs. And the second thing is that, what does that mean for earnings? It means that there is a sustained path forward for earnings growth of over 30% per annum. And that's without having to really make any very bold assumptions about growth rates. So that's a company that has done very well in the past, but we think will continue to do well going forward because of that just significant addressable market within the obesity. The final high conviction idea that I want to share in today's video is just talking about small caps. So small caps have been a pretty significant underperformer versus large caps over the last 4 or 5 years or so, which has basically meant that small caps now trade at a significant discount to large caps, trading at about a 16 times forward multiple versus 25 times for the sort of large cap growth stocks. So significant discount there. So that just gives us a better margin of safety. And the second point that we would highlight is that small caps tend to do best just after interest rates peak, which we're expecting to see sometime this year. So that certainly means that our starting point is good, our margin of safety is good, and our timing in terms of when small caps tend to do well is also pretty good. So we think from a risk adjusted perspective, now is a good time to be pushing capital into small and mid cap companies, albeit with a mind and an eye towards quality, because obviously we don't want to just be buying any small cap stock or company. We want to be investing in the best quality small cap stocks. So there are a few ways to play that, which we can talk to investors about further if they have any interest.